G'day folks, welcome back to another update for the S&P 500 and the NASDAQ. Now it's broken new highs, but watch for that divergence. We might still see a pullback at some point. There's still a bearish divergence. If we go any further, make sure you hit that like and subscribe button to support the channel. Also reference the +1 videos, which I did one a few days ago, demonstrating these 4 strategies. So always reference those to get a better insight into the trading strategies. Also in terms of the outlook, bottom line for the S&P 500, fundamentals are solid overall. Earnings are continuing to beat expectations. Revenue growth steady, albeit slowing relative to earlier in the year, and monetary policy easing is supporting valuations. However, the risks from overvaluation, inflation and policy remain. For the NASDAQ, the tech growth names have stronger growth momentum, particularly from AI and cloud, but are more exposed to downside from policy shifts, rate moves and any slowdown in capex or earnings surprises. So looking at the S&P 500 first, we'll go to the weekly chart. And here you can see we've got a very long-term bearish divergence, lower highs on the CCI versus higher highs on the price. Hasn't started to pull back yet. They could keep rising, of course. As long as the CCI keeps dropping and the price keeps rising, we're going to keep that bearish divergence in play. So at the moment, bearish divergence, although the price is still rising, so just be cautious of that. On the daily, likewise, we've got another bearish divergence. You can see there, declining peaks on the CCI versus higher highs on the price, and it's hitting this resistance up here at 6,600. So it could possibly go higher than where it is at the moment, but so long as that CCI keeps dropping and the price keeps rising, we're going to extend that bearish divergence. And again, just going back to a bit of history here, we had a few, these rectangles are marking the 23-38% retracement of those Fibonacci, So back here, for example, we had a Fibonacci range going back to that significant low. That's a 23-38% minimum range, and more than 90% of the time it hits that 23-38% range. So that, again, that was targeted by that little rectangle. Another one there between that Fibonacci range there that hit the target. Another one there just touched it and it bounced out, and this larger one was also penetrated if we pulled back the Fibonacci right down to this area here. And what I've got here is these circles highlighting key pullbacks or key corrections in the market. This was the 2022 inflation and Fed tightening. This is the COVID-19 crash, and back here we just the tail end of the GFC. So they all had bearish divergence, and then subsequently some of them had also bullish divergence. You can see their little bullish divergence there started to bounce. Bearish divergence dropped, and bullish divergence bounced from there, and so on. So where we are at the moment on the daily, we've got a pretty long-term bearish divergence to be careful of. On the hourly, we work backwards. You can see there, if we zoom in, we've got a bearish divergence at the moment, and I've drawn a target range there. Now that target range is drawn from that high down to, we take it back to the previous significant lows. So each of those were lows, but again, significant, something that really stands out, and that's probably the first one that stands out there. Then after that would have been this one down here. So that one there, that's where I've marked that 23-38% range. So we can expect, if the price starts pulling back from where it is at the moment, we can expect it to touch that range. There's a good 90% chance. Otherwise, the price could keep rising, in which case we have to then extend the divergence ranges. So that's the hourly. Now, if we go to the back tests, now for these 2 strategies, again, reference the +1 videos we did last week, which demonstrates here I've got the CCI14, but also the CCI350 strategies, both doing quite well, obviously, with the price on the daily moving to the upside. So you can see there for each of these periods, you would have been closing it out on the daily at the latest when the CCI broke into the moving average range, each of those points there. And this one here, for example, where there's a drawdown here, you'll notice there on the daily, the CCI pulled back into that moving average range. And ideally, you want to go long on the hourly when the CCI is in an uptrend, and so is the price above the moving averages. So you can see there, just repeat what I said about the on the daily chart. So you would have gone long at that point there when the CCI broke above, and so did the price, and you would have closed out your trade on the 1 hour period when the CCI broke into the into the moving averages of the CCI moving averages there. That's where you would have closed it out near the top there. Wait for it to break higher. There might have been a false break there possibly, but wait for it to break higher there. let it go on the hourly, and then close it out again when the CCI breaks into that. You'll notice the CCI gives you an early warning to get out near the high rather than waiting for it to break into the moving average of the price movement. So again, each of these reaped quite good rewards. This one generated about $106,000. This one generated about almost $91,000. And a feature of these drawdowns, you'll notice here, for example, again, back here, that's demonstrated by that period back there on the daily. Touch the moving average of the daily chart, you would have not traded these drawdowns in each of these respective areas. But also paying attention to the bearish divergence throughout the 1 hour time period as well. This is the NASDAQ. So on the weekly, first off, the price is above the moving averages, gives you a nice big bull run. Again, notice the CCI made a bit of a high there, but still lower than this point back here, which is where we're measuring it from. Even back to this point, to be honest, that's probably where it should be for the same period on the price chart. So declining CCI highs versus higher highs on the price. Now I draw a target range there. Since then the price has moved higher ever so slightly. So if we pull back a range, a Fibonacci extension, a Fibonacci retrace, we go back from that high there now, and we take it back to the low before that. You can see there it's a very minor change of a 23-38% range. Just extend that there, and we remove that Fibonacci. That's the new 23-38%. So again, a bit early to call that. It could actually go a lot higher, but so long as that CCI keeps dropping and that price keeps rising, we're going to consider that a bearish divergence. Weekly chart. The daily, it's hit this resistance up here at 24,135. It just rose slightly from our previous video. And again, notice here we've got a bearish divergence as well. This is a new one. Back at this point, before our last video, we had a declining price, but also declining CCI. There was no bearish divergence until now. That high has gone higher than that high there on the price versus the same period on the CCI has dropped. So that's a bearish divergence. So if this was to then drop further, we'll draw a Fibonacci from that high. Now, I'd like to take it back to the significant low. We can take it to that level there. That'll coincide with these moving averages. Excuse me. That 23-38% range, but very likely it's going to drop further if it does drop down below those moving averages, and that's down to that significant low there. I won't draw a target for it yet until we start seeing a significant drop in it, but that's showing a bearish divergence on the daily as well. Now on the hourly, we've got here is a double top on the CCI. Again, just working backwards from these charts, you can see there that's a double top, if not a slightly lower high on the CCI, but I still consider a double top a bearish divergence in this case versus higher highs in the price. Now again, if this is to fall back where it is at the moment, it could go higher. I keep saying that because there's no chance, we don't know exactly where it's going to start turning, but if it starts to pull back, we're going to draw a target range between that 23-38% range. So that's the hourly there. Now going to the back test, again, here's the CCI 14 on the left here, on the right on the black is a CCI 350. You can reference the +1 videos to get a more detailed description of those. But you can see there, here, you would have avoided this drawdown by looking at when the price here on the daily, zoom in a bit, when it hit that moving average range, you would have got out of the trade, and that was at the very start of that period back here. You would have got out near the high there. You might have had one contract open, but nonetheless, if you were trading through that period, that would have been quite a nice little return, and you would have avoided that drawdown. That's for the CCI 14. The CCI 350 wasn't as much in terms of a drawdown at the later stages there, but this one back here, let's see what that did there. So that was back on the 16th of June. So let's see if we had the 16th of June back here. You can see at that point there, you would have avoided that drawdown, a small drawdown, but this one back here, again back here, notice here on the 12th of June, you would have got out of the trade there, and that would have been at the very start of that as well, maybe with a contract open. So you would have avoided all those major drawdowns on both of those strategies had you followed the daily CCI trend when it breaks in the moving average range. Again, reference a +1 videos to get a deeper dive into the trading strategies, but also if you want to get some more insight into bullish shares, we do a weekly scan of bullish shares across various regions of the world's markets. So subscribe to my Patreon page, at least on a free trial, and hit that like and subscribe button to support the channel. We'll see you in our next video. Thanks for watching.